What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the Stocktrades YouTube channel. For one, I apologize for the lack of videos as of late. I had gotten caught up in the development of our ETF platform over at Stocktrades a week prior, and then I got a pretty nasty cold. I couldn't really speak. I had to save everything I had for the TCI podcast. I really didn't have it in me to film a video, but this week we're getting right back to the videos. Again, multiple videos a week on stock reviews, ETF reviews, whatever I can think of. This week, we're going to be going over a generally unpopular US retail ETF that has provided some absolutely outstanding returns over the last decade, and that is the Vaneck Retail ETF. This ETF is not that large, it's not that popular, yet it has driven some very strong returns for investors over the last few years, and we're going to dive right into it in this video. Let's go. So again, everybody, as always, head down below, subscribe to the channel, like the video, and comment down below what you want me to review next. And if you're interested in the No BS newsletter, this is a 2 times a week newsletter we delivered to over 25,000 Canadians. Stock picks, ETF picks, market commentary, case studies, anything you can think of. You can head down below to the description, click the link, and sign up there. You're also going to get filled in on the brand new ETF platform we're launching June 1st. We're going to have a fund screener that scans over 5,300 funds. We're going to have 50 plus data points on all of those funds that are going to help make your life easier. In addition to this, we're going to be delivering monthly newsletter issues. We're going to have a Q&A where you can ask us any questions you want. And if you even want to take it a step further, we're going to have a private Discord, much like our premium platform, where you can get in there and speak to me live in real time. I'm responding to thousands of premium investors on a daily basis inside that Discord. But get all the details on that in the No BS newsletter. But let's jump right into the video where we're going to go over Vanecks Retail ETF. So I've been digging into US retail ETFs for quite some time now, primarily because they provide a lot of exposure to the US retail industry, which is going to be cyclical, but is also going to be able to rebound from a pickup in economic activity. We're pretty slow right now. The economy is slowing down. There's no doubt about that. We're seeing a lot of companies like Starbucks, like Home Depot, like Lowe's, even a company like Walmart is slowing down. They're warning of a weaker consumer, but ultimately, if interest rates continue to decline, if they start to decline, there should be a pickup in consumer spending, and as a result, retail ETFs should stand to benefit. Now, if we look to the Vaneck Retail ETF, I looked up about 5 or 6 major retail ETFs here in the United States, and I really couldn't find one as good as RTH, the Vaneck Retail ETF. So this fund seeks to replicate as closely as possible the price and yield performance of the MVIS US listed retail 25 index. So this is going to contain 25 of the best retail companies in the United States. I think the reason for this fund's outperformance relative to other retail ETFs, which I'll look at a core one when we go over the performance of this fund, is the fact that it is a very concentrated fund. The one that I will cover later has around 80 to 90 holdings, I believe, whereas this fund is really concentrated on 25 of the best. So to be eligible for the index, companies must generate at least 50% of their revenues from retail. Retail includes companies engaged primarily in retail distribution, wholesalers, online, direct mail, and TV retailers, multi-line retailers, specialty retailers, and food and other staple retailers. So this fund has fees of 0.35%. This is on the high side, but again, with these more niche ETFs, you're going to see higher fees. They're not going to be as low as, say, a Vanguard S&P 500 ETF, which is probably like 5 basis points, 0.05%. So you're looking at 0.35%, which is $3.50 annually for every 1,000 you have invested. It has assets under management of $206.75 million, which is relatively small considering how long this fund has been around. It's been around since, as it looks like, 2011. So over that 13-year period, it's really only accumulated $206 million in AUM, which is pretty small for a US ETF, especially one that has performed this well. I pulled this ETF ETF out by screening the 5,300 plus funds we have here and looking for top performers. And I found it to be a very interesting ETF, so I decided to go over it. But it just hasn't caught that much, ground in terms of popularity. It has a distribution yield of around 1%. This is definitely a total return fund. It's not something you're going to look for to generate income or anything like that. And if we head down below and look to the details of the fund, we can see it contains 26 holdings. So this might vary. It might contain 25 stocks and a cash position. We'll look to that a bit when we go over the holdings. Now, the weighted average PE ratio is nearly 25. US retailers, they're typically pretty expensive. Most of them have pretty large economic moats. I mean, we're talking Home Depot is borderline impenetrable in terms of renovations, things like that. They do have Lowe's as competition, but the two of them are just absolute giants. We can think of a company like Walmart, a high volume, low margin business. These companies typically don't ever trade at discounted valuations because they are very strong. They provided long-term results for shareholders. We see return on equity, median return on equity of 33%. That's outstanding. Return on assets of 9.91%, very solid. Forecasted dividend yield 1.29%. Again, you're not buying this for the income. When we look to the forward PE ratio, we're seeing around 20.83. And when we look to the trailing PE of 25 and we see a 21 forward, that means that analysts don't necessarily believe that this fund is going to grow, the underlying holdings in this fund are expected to grow all that fast moving forward. Earnings growth when it comes to retailers right now is not the best because of the weakening economy. This forward PE ratio will be the next 12 months forecasted earnings growth. So they are expected to grow earnings, but not typically by the amounts they usually do. So there's been a slowdown, which is not a surprise at all with the state of the economy. When we look to risk metrics, we can look to 10-year risk because this fund has been around for a decade. It has an alpha of 6.25. Alpha is, if we think of beta as the overall risk in terms of the markets, with a beta of 1, tracking the market relatively well, and a beta of 2 being it is double the volatility of the overall market. Alpha kind of represents the returns of the fund over and above the market return. So if you have something that has a negative alpha, it's typically underperformed. Whereas if you have a positive alpha, it has outperformed. A alpha of 6.25 over a 10-year period is very, very strong. And when we look to the max drawdown over the last 10 years is 24.99%. I mean, there is a lot of funds a lot of stocks, funds, anything you can think of during the COVID-19 pandemic that absolutely collapsed in price. And I would imagine that this 25% drawdown is probably from the COVID pandemic as well. Yeah, you can see March 2020. But before that, you're talking max drawdowns of, 20% at the peak. It went in when the market severely corrected in 2018, it lost 21%. But overall, this has been a relatively low volatility fund. So when we go to the allocations of the fund, again, this is a pure US fund. It's a pure stock fund as well, 99.98 and 0.2% cash. Pure stock fund and pure US exposure. I mean, it has a little bit of exposure to China, 3.41%, but for the bulk of it, you're buying US retailers with this fund. When we head down, we can see that, 28% of the fund is consumer defensive, 12.4% healthcare, and 60% pretty much consumer cyclical. And when we look to the overall makeup, for the most part, this is going to contain large cap companies. We're seeing nearly 40% exposure to large cap blend, which would be a combination of growth and value. And we're seeing around 21.5% to growth. There's a bit of mid cap exposure, 12.4%, but for the bulk, you're getting large cap retail companies in the United States. In fact, 50% of them are giant cap, which I believe is a market capitalization of 100 billion or more. So let's dig into the holdings of the fund. We're going to see many of the top retailers in the United States in this ETF. Now we're looking at Amazon. They make up 21.59% of the portfolio. This is very, very heavy. You're looking at 1/5, a little over 1/5 of this entire retail ETF is allocated to Amazon. Now, I'm not sure how this was historically weighted, but I would say if this fund has been heavy on Amazon over the last decade, that is a huge, huge contributor to its outperformance. Now, that's not to say that companies like Costco, Home Depot, Walmart, Lowe's, TJX, we're looking at Target, CVS Health, AutoZone, Lululemon, that's not to say that these companies haven't necessarily performed well. It's just Amazon has performed, outstanding. If we looked at 10-year returns on Amazon, we're looking at 1,120%. So you're looking at an 11 bagger. Whereas, many of these other retailers, Costco will be pretty similar in terms of overall returns. We're looking at 750%. Home Depot is probably up there. They've had a meteoric rise over the last while, but even then 446%, just nowhere near Amazon, just with the boom of online ordering, online e-commerce, things like that. Now, I'm particularly bullish on Amazon, which is why I like this fund in the first place as well. I do believe they have a ton of growth potential outside of their slower growing retail end of the business. They got advertising segments. They have their cloud platforms. They are just growing in so many ways that their added exposure inside of this fund, I'm actually not all that worried about. However, there is no doubt they are probably valued a little expensive at this point. Huge run up in US tech. So if you're worried about that concentration risk in terms of Amazon, that might be something you want to consider moving forward. Outside of that, we can see, again, some of the best retailers in the United States, and it's a relatively concentrated portfolio. You're looking at, again, 21.5 to Amazon, but after that, you're looking at, for the most part, a lot of the companies inside of this portfolio will have low single-digit weightings. We have high single-digit to Costco, Home Depot, and Walmart, but really, is that really all that bad? I would imagine that these are, three of the premier retailers in the United States. I'm sure many investors would not mind having, solid exposure to them over the last while. And when we get to the back end here, we see, the dollar stores, Dollar General, Dollar Tree, most of them, Dollar General has struggled as of late over the last while. We can see that it's taken quite a dive off highs. The one misconception about Dollar General is that it's a pure dollar store. It's not. It contains a wide variety of products, and it has really struggled. Same with Walgreens. But again, these are relatively low exposure to the portfolio. You're looking at, sub 1% or, 1.5%. But overall, I like this makeup of holdings. It's got a lot of growth into it. Home Depot should be set to perform quite well moving forward. Full disclosure, this is one of the largest individual stock holdings inside of my portfolio. I think it will really benefit from a resurging, incentive to renovate your house in the United States rather than sell and buy new. We have to remember in the United States, their mortgages typically go on for the entire 30-year term. So if you have a 1.8% pandemic locked in mortgage here in Canada, after 5 years, you'll have to renew that mortgage. Your rate will go away unless you were lucky enough to sign a 10-year fixed mortgage if you kind of planned it out like that. But in the United States, you can keep that rate throughout the entirety of the mortgage. This creates a big incentive to renovate your home rather than sell and buy another one, because you have to think, if you have a home right now at 1.8% and you sell it, US mortgage rates are north of 7%. You're going to pay so much more money to buy a new house. So I believe the incentive for renovation there, and in terms of Canada, in terms of our housing shortage, how many new houses we need to build, I'm pretty bullish on Home Depot. Costco, again, very bullish on Costco. They just have the best operational flywheel arguably in the world. They get members in, members come in, they pay the membership fee, which allows them to order more goods, which gets them better prices from suppliers. In turn, they can sell it to customers for cheaper, which in turn gets them to renew their memberships, to recommend the stores to other people who come in, grab memberships, which again creates a revolving circle of increased traffic, allowing them to get better prices from more bulk purchases from suppliers, and it just goes on and on and on, which is why the company has been practically unstoppable over the last while, and I really don't think that's going to slow anytime soon. And I've already spoke on Amazon. Walmart, great defensive retailer, and then after that you have Lowe's, which is kind of the same situation as Home Depot. TJX, I don't really know too much about. Target is a solid retailer. They've had actually a pretty, strong rebound and growth over the last while, but they should be able to benefit from an increased economy when rates ultimately come down. So now that we've gone over the holdings, let's dig into performance. And this fund has performed exceptionally well over the last 10-year period. If we go to a total return basis and we add in, let's just add in SPY and S&P 500 ETF, we can see that over the last 1 year, the S&P 500 has outperformed it, but that is really not all that surprising considering the retail exposure. Retail is cyclical. It is going to decline when the economy gets weaker. And I mean, we're looking at late 2023, it was still outperforming, but it's kind of lagged as we head into 2024. But when we span that out to a 5-year period, it gets to be relatively equal in price. And when we go to 10 years, this is where the fund really stands out. You're looking at, let's look at this from an annualized basis. You're looking at annualized returns of around 14.7%, while the S&P 500 has returned just shy of 13%. It has outperformed the S&P 500 over the last 10-year period. And again, I mentioned that big caveat. I don't know if it had that level of exposure to Amazon in the past. If it has, this is primarily why it would have outperformed. I mean, you have an 11 bagger in terms of Amazon making up that huge chunk of the portfolio. So this is going to be a main driver of the outperformance. And when we span it out to just all time, which would be 2011, you're looking at the performance getting even wider, 16.04% annualized versus 14.48 for the S&P 500. Do I expect it to perform this well moving forward? Not necessarily, unless it can kind of catch lightning in a bottle with another, retailer like Amazon that has driven so much of the returns moving forward. But I do expect it to perform quite well when interest rates come down, when the economy picks back up, when people start spending money on discretionary items at things like Costco, Home Depot, Lowe's, all that type of stuff. I believe you will see this fund rebound. A lot of these companies are in a great position. They've been able to withstand most of the storm already. And if you could say we're at peak rates right now, a decline in rates should likely help these companies out. And this concentrated portfolio of U.S. retail option is great for U.S. investors looking for that single click exposure instead of picking individual retailers. And it's great for Canadian investors who want to own a basket of US retail, because as far as I know and as far as I've looked, and I have access to, again, 5,300 plus funds, I can't really find a Canadian specific ETF that focuses on US retail companies. So if you want a fund like this, this is one of the best performing. So the fund I did want to compare it to is XRT, which is the SDPR retail ETF. Now, this is a little bit different structured. It still is an index fund, but it has way more holdings. It's also a bit bigger. The performance has not been as good as the Vaneck one. If we go to the total holdings, we can see that, I mean, the number one, I'm not a huge fan of this fund. I mean, for the most part, it's not like it's equal weighted, but it has a lot less exposure. But I mean, we're looking at the top holdings being GameStop and Carvana. I mean, I'm not Victoria's Secret, Nordstrom. I'm not a gigantic fan of this fund. I mean, I do like the concentrated exposure in the giant caps over, probably a wider net. I don't know the methodology of this index, and I'm not going to dig into it, but why is GameStop the number one holding inside of this fund, even though it's 2.13%? I mean, fundamentally, I don't think this should be included in any ETF for that matter in terms of retail. Especially with the whole meme stock craze. But in terms of performance, when we look to XRT versus the Vaneck fund, we can see that the Vaneck fund has performed quite well. Both of them have crushed the index over the last while, but the Vaneck fund it's a solid performer. If we exit out of the S&P 500 here and we just want to look at the two funds together, it's outperformed pretty much over every time period as of late. I mean, year to date, still outperformed. 1 year XRT has actually outperformed it. I don't exactly know why this would be, but generally over any timeline you look, this concentrated exposure of US retail companies has outperformed a wider net. So what do I think of the fund? I'm actually a pretty big fan of the fund. I realize it's not going to be for everybody because of the concentrated exposure to Amazon. I realize that you have to acknowledge that risk. If Amazon were to undergo some difficulties, have a large drawdown, this fund would be significantly impacted. There's no question about that. So you need to understand that if you're looking to add this to your portfolio. But outside of that, it contains a relatively strong portfolio of rock solid, for the most part, blue chip, fast growing US retail companies that should be set to rebound quite nicely moving forward as the economy improves. So I hope you liked the video, everybody. Head down below, smash that like button, subscribe to the channel. Again, no BS newsletter in the description below, 2 times a week, free stock picks, ETF picks, market commentary, all that type of stuff. And you're going to get on a short list, which is going to go over our brand new ETF platform that is launching June 1st. You're not going to want to miss it. We're having an unreal opportunity for those who get in on launch, and you can learn more about that when you sign up for the newsletter. And as always, stay tuned for more great Canadian content.